The whole point of an asset allocation model is to not invest in the same asset class, either just large cap or just small cap or just bonds, for example. The idea is to spread it around. And as one goes up and becomes a bigger proportion of your portfolio, and another asset class maybe doesn't do as well or goes down and becomes a smaller part of your asset allocation portfolio, the idea is to rebalance them and take some off the one that maybe was 25% of your portfolio. Let's say now it's 30% of your portfolio, and another one was 20% of your portfolio. Now it's 15% of your portfolio. Move that 5% from the higher one to the lower one and bring them back to alignment with what you originally set out to do. That's what an asset allocation model does. It's supposed to help you mitigate the risk, and it's really supposed to just keep you exposed based on your risk tolerance to managing a portfolio for you. The only way to do better in an asset allocation model is to contribute more of that asset allocation model into the best performing sector. So maybe there's 5 sectors in an asset allocation model: small cap, mid cap, large cap stocks, international, and bonds. An asset allocation model could be 20% large cap stocks, and you could use a popular exchange traded fund for that. This is VU. It's got a good brand name like Vanguard, and it's a low expense ratio. But it hit a new 52-week high, and it is up for the year 15.45%. And that's the benchmark. That's how the S&P 500 is doing. But then you look at mid cap stocks, and this is VO. Well, it's only up not even 5%. So if you have stock money, if you own an S&P 500 index fund, you're doing pretty good, right? Up 15.5% this year. But if you divided that between large cap S&P 500 and mid cap, which is this one that I'm showing you on the screen right now, it's only up 5%. So it's lowering your average return. And then if you look at VB, this is the Vanguard blend between growth and value, the small cap ETF. This one year to date is only up a little over 2%. So when you start to diversify away from just large cap stocks like the S&P 500, you're lowering your return because the other asset classes are not doing as well. Remember, the S&P 500 is being led by the mega cap tech stock. And then you look at the big bond fund, BND. This is the all-encompassing Vanguard Total Bond Market Index. Year to date, it's down almost 1.25%. And short-term bonds, this is the big short-term bond index fund, is down 0.3%. So you see what's happening. If you are an asset allocation model investor, a pie chart investor, assuming you're allocating that much money to the S&P 500 index, you could see why your overall portfolio is not keeping up with the market, because all of the other asset classes are not doing as well.